Yeah, welcome to today's class. Uh, yeah, welcome to today's class. As usual, we have to give maybe 5 minutes grace for others to join before we start the class proper. We just stay tuned while others join. Thank you. So we're waiting for others to join so that we can kickstart the training. So as usual, we are giving 5 minutes grace for others to join. Stay tuned while we wait for them. Thank you. You have to reduce the thing when you do so that make your family and you will not talk to it. Yeah, welcome to today's training. As usual, we are giving 5 minutes for others to join before we start the training. Kindly stay tuned while we wait for others to join. Thank you. So we have 4 minutes more for others to join, those who want to join the class, so that we can start the training. Thank you. So those that are already on board, so as we all know, today is we're going to end this class training today. Meanwhile, we still have some other area that we are unable to cover, which I will also work out time and cover those areas, like the moving average and more on the Japanese candlestick. So we create time to have a day class to cover all that, and also price action. So that price action, I really wanted to discuss on that today, but I don't think time will permit me to do that. So we fixed a day for the training on price action using of the Japanese candlestick and moving average, including Fibonacci retracements. So I think I'll work out time to give training maybe 2 days on these other topics which we are unable to cover this on this part of this training. So we do that, and we are doing to ensure that every one of us use to those elements, those factors we need to combine together for you to have a wonderful trading experience anytime you do your trade. So I welcome you once again. So we just have 1 minute left so that we can start the training proper while others join. So welcome you once again to this last training session. So I we do other things. Maybe I'll send some notes through the WhatsApp groups, so that we're able to keep uh, learning, keep learning. So that's what forestry is all about. You learn from your mistakes. Sometimes you make a trade. If you lose that trade, so you only need to learn from that mistake. So in the next trade, I believe you mean the experience I've gotten for your loose trade will help you a lot in your next trade. So those are the learning process that involved in trading. So trading has to do with the learning curve theory. So the more you trade, the more you learn. So like me when I started trading, I keep trading and keep learning. So that was how I was able to get to the level I am today by the grace of God. So I think we should start now. So here we are proper. So we are going to cover in this disabled training or types of traders. So you're able to know what the one that you are properly fit in, so that whenever you are asked, so what type of trading you are, so you're able to say, okay, I'm so trading. So every trading trader have time. So the time that you have, we actually um, we actually define your we actually defined your type of trader. So time factor. So it's first thing that you always consider before you choose the kind of trader you want to be when you are trading forex. So some people may have a shorter time on a daily basis from Monday to Sunday during the time the market is hardly open. So some will have a higher time. So the time that you have or have a long way to determine your kind of traders you're going to be. So now before we go into that, so we're going to actually discuss something which I feel is very important for every one of us to know before you start trading, before you start your market analysis. So in your next last class we actually discussed about types of market analysis, that we talk about fundamental analysis, we talk about the technical analysis, and talk about the trading analysis. So now before you even consider those analysis, things to consider in your trading analysis. So we are trying to list some, so that whenever you open your charts and you want to trade, so you're able to try and uh, get information from this area before you now arrive at your decision on trading or your trade for the day. Depends on the time that you choose to trade. Now, the first thing that you consider is the forex market development. You know, let's just take for example, we are talking about use cryptocurrency as our case study on this first thing that you need to consider. So cryptocurrency, whenever Bitcoin is being mentioned in the news, once it's good or bad, so it instantly reflects on the price of cryptocurrency, majorly the Bitcoin and the Ethereum and the major cryptocurrency. So same thing applies to markets. So what are the development? What are the news? Like we talk about the which is all about US, Canada, and is a great development. So those are the things that the analysts will always come about if concerning some currency. So you check the reaction of market based on those analyst information. So that is one of the things that you consider. So another thing that you consider in your analysis is the news release. Now you have properly analyzed the market and you want to enter a trade. So before you enter a trade, this the news, you believe that there is news coming up. Say for example, you want to trade Euro USD. So once you open your charts, you have done an analysis on Euro USD, which you want to trade for the day. So the first thing, the after you have checked the market development that concerns those two, if there is none, so the next thing that you go into, you check what are the release that are coming up from the USD side and the Euro side. So those are very key that you must be aware of. So that is the reason sometimes every morning I send those news release to the group so that you're able to know what news are coming up, because most of these news may have impact. If you have already entered a trade and the impact, the news now being released and is against you, so it's going to affect your account. So the reason is that's the reason why you should consider those news before you take a trade during your market analysis. So know what news reports are coming out each day and how they affect the market. So you already know, okay, that there is a news coming up during London session, during Jama session, and certain news are going to be released concerning which is going to affect euro currency. So now what do you do? It's either you wait for that news to be released so that you will now know what the sentiment is going to be. If those news that are in high impact come positive, you're able to know, okay, euro is going to have it was going to appreciate. So if it's negative, you already know that euro is going to depreciate. So you take advantage of that at that time. So you consider the news release. The next one that you also consider is the market price of uh, other asset classes. So we talk about the US Treasury yield. So if you know, for last month or so, the US Treasury yield was really going up, and as a result, it really helped USD at that period. So when the USD Treasury yield is going high up, is appreciating, it also helped USD to go up as well. So once you have the idea of the direction of the US Treasury yield, you'll be able to predict to some extent when where the direction USD is likely to go. Same thing goes to the price of oil. So some countries that rely on commodity like oil, now, when there is a news regards to the price of oil, definitely you see the impact on card, because card is one of the commodity currency. So major their major source of income from foreign currency is through the export of crude oil, majorly to the US. So when the price of oil goes up, it appreciates the card. When it goes down, it also depreciates the card also. So you very important for you to know the prices of other asset class. Oil is attached to card. We talk of gold, that's Australia dollar, AUD. So whenever there is a depreciation in gold price, so you go and check the EUDPS, you see the impact on it. And when it goes up, the price of gold go up, it also appreciates EUD. So those are the things. So there are some assets, there are some commodity that's actually attached to currencies, that the price of those assets determines the price of some of the currencies. So it's very, very important to also know those currencies and how it affects the prices of currency. So you also notice that sometime in the morning around maybe 7 GMT, so when the London session, when the stock prices are being released, sometimes when it's come out negative, it affects the price, the value of euro as well. So the last one is the current event. So we just want to use Donald Trump as a case study. So whenever the Trump come up with, so you see, okay, major election, military conflict. So two nations, if there's any conflict, maybe China against US, market will react to it instantly. If it's a current a political scandal, talk about the Brexit. The Brexit, you see how the news of Brexit moving Great Britain up and down. So those are the current events. Whenever this event has been released, calls out, market react to it. So you consider those when you are doing your market analysis. So now we go into we talk about now we're going to talk. Okay, lastly, you still review the chart. Finally, after going through all your daily economy analysis, you have to look at the chart. Chart will give you insight into key support and resistance level, trends, and possible price points in which to enter the market. So now we go into types of traders. The first one we talk is scrapping. So this type of trading is majorly for those that have much time to spend on their system watching the charts. So if you are the kind of, maybe you are a student and you have a free time, you are on holiday, so the best that you can take if you feel that you have the time to be on the system is a scrapping system. So in this scrapping system, the strategy is just simple: holding a trade for few seconds to some few minutes at most, and you close the trade. So you only take advantage of little changes. So you are not expected to have a trade that will give you much profit unless you set a very high lot size, which also will be very risky to your account. So the major objective for forex scalping is to grab very little amount of pip as many times as they go throughout the busy period of the day. So how do you do it? You target very few pips. So as a scrubber, you may target maybe 5 pips, 10 pips, 5 pips. Once you take like 5 pips, you are out of the trade. So you now wait for another opportunity. Maybe you take 5 pip up using the 5 minutes chart, or 1 minute, also even 15 minutes at most. Usually is 15 minutes. 15 minutes is even too long. Maybe you start within between 1 minute to 2 minutes, 1 minute to 5 minute chart. So once the market goes up within 2 minutes, 3 minutes, 5 minutes, you place your trade. You take your you buy low, you sell high. So within 5 minutes, you will exit, take 5 pips, take 10 pips, take 4 pips, like that. That is how you are scrapping it. It suits for those who can spend several hours undivided attention to their trading. So since it is not for those looking for to make a big win all the time, but rather for those who liking a small profit over longer period to make an overall win. So as I've said, the major time frame you should look at when you are scrapping is 1 minute or 5 minutes. So you may not use the 15 minutes because it's too high for scrapping. So 5 minutes or 1 minute for scrapping if you have enough time to always be on your charts watching the market movement. 5 minutes, 1 minute, you scrapping time for a scrap trader. So now let's look at what makes you to feel that you can be a scrapper, that puts you, if you can actually be a scrapper. You like fast trading and excitement. So maybe you have that time. So some people are good at trading, but also you want to use that for fun. So you just see the market movement. Once you see market get to a resistance on 5 minutes, you place a sell. Immediately you see that it's come down within 2 to 3, 5 minutes, you exit the trade and now wait to buy again or you sell. So you might not be focusing on charts for several you don't mind being focusing your several hours at a time, it means that you believe you have already made up your mind to spend much time watching the charts all the time, because as a scrabber you must have enough time to be on system. You are impatient person. It means that you are not the kind of person that can watch or that can just place a trade. Maybe you just walk out, say okay, in the next 15 minutes, 20 minutes, I will come back to check the trade on this your trade. So that will make you to be watching your trade all the time. So that you're able to take little profit out of the trade and look for another opportunity. So if you is another thing is that you might not be a forex trader if you easily get stressed in fast moving environment. So now you see how so how do you cope with the environment? Do you have that time? So you cannot commit several hours. You cannot trade with just few pips. More you can rather make few trade with high profit. So some people just choose to, okay, let me set two trade. Those two trade you are expecting a higher profit than trading on the higher volume with a smaller profit. So trading on higher volume does not actually determine the profit you are going to make from trade. So some that choose trade on few pips, they trade, they make higher money than a scrubber. So it's not all about the numbers of trades that you place. It's all about your accuracy and the pips that you're able to get after the trade. So now we go into some things to consider if you want to decide to strap. Now, one of the major things you consider is the trade only the most liquid pairs. What we mean by liquid pairs is that there are some pairs that when you are trading it within that 5 minutes, on a 1 minute candle, the spread will cover almost the whole candle. So you avoid those kind of a trade. Only trade busy period. Which period is the busy period? Is the London session, then overlap to the New York session. So this is always the busy period that you can trade as a scrapper, because you cannot scrap when the market has a very low movement. So you cannot scrap. So you only scrap when there is high movement, busy period time, which is the New York time and the UK time. So that is the period that you should scrap. So another thing you should follow is you must make sure that you use good money management. Good money management is very also key when you are scrapping, because there are some trade that you will scrap, you feel that you want to set a high loss size, believe me that it will go to your way. So if you end up going the other way, what do you do? So it's going to have a negative effect in your account. So when you are scrapping, make sure that you have a good money management in place. So now we move to day trader. Now we talk about the day trader. Day trader is just a form of another short-term trading. So it's not a long-term trader and it's not a scrapping. So it's also a short-term trader, but it's basically trading on a few trades. Just as I've said earlier, it's not how many trades that you actually traded that determine your profit at the end of the day. So as a day trader, you have time, but not enough time. So you typically only take few trade a day and close them out when the day is over. So you can choose to close them out when the day is over. Also, you can choose for the trade to run to the next day if you feel that there is need for that. So it simply means that you are taking it to be a swing trade. So from day trade to a swing trade. So you can turn your day trade to a swing trade if you feel that the need arise. But generally, as a day trader, you open some few trade maybe during the morning period, which is the London session period. So you close maybe before the New Year session if you are already okay with your profit, because it's all about setting your take profit and your stop loss. So if during the day, maybe at breakfast time in the morning before you go to work, if you are a working class, so you can simply place your trade and place your stop loss. So now during that period you'll be at work, you'll be busy. At lunchtime, all you need to do is to open your chart and see what is happening in the market. So as a working class, you can a day trade trading. So you start, you place your trade in the morning, or maybe you can use your phone to also monitor your trade. So before you leave home to work in the morning, you've already done your market analysis. So after doing your market analysis, you place your trade. Now what happened? So lucky, fortunately now you have the iPhone. So all you need to do, you use your mobile phone to monitor your trade even when you are at work. So for you, maybe you've not trade and you also still want to trade for that day. So if you didn't have the time, or do you have a good entry during the break in the morning, so at lunchtime you're able to see, have the time to open your charts and do your analysis before you resume back to work. So as a day trader, working class, you can choose a day trader because it gives you time. So the day trader is only suited for have enough time throughout not really enough time, sometimes throughout, to execute and monitor. If you think the scrabber is too fast, but swing trade is a bit slow for your taste, then day trade might be good for you. So that's for day trade. Now, if you might be a day trade, you like beginning and ending a trade within a day. So that's your system that you want to adapt as a trader. So because everyone have their system as a trader, the system that you want to adopt. So one of the system will be you want to open your trade in a day and close it in a day. So it means that you can be a day trader. So now, as I've said earlier, there are some trade that you may feel that was you actually wanted to trade that trade as a day trade, but there are some names that will make that trade to run become a swing trade. So you might have time to analyze the market beginning of the day, which is in the morning, and can monitor it anytime during the day. So as a day trader, you'll be able to have time to be at the beginning of the trade market to analyze and to place a trade, and have time anytime during the day to also monitor the trade. So if what you might not be a forex day trader, if you like long or short time trader like swing trade, you don't have enough time to analyze the market or monitor the market during the day. So now you are placed trade in the morning, and there is no time for you to monitor your trade during the day. So it's not a good one for you. So now we go to swing trade. So this swing trade is it's a trading system for those that are working. So if you are a working class type, the best trading system you should use is swing trading. So this swing trading is a long time trading. So it can take 1 day, it can so depends on how you want and how you have analyzed your market for you to know when to buy and when to sell. Swing trade is a long time trading style that require patience to hold your trade for several days at a time. It is ideal for those who cannot monitor their charts throughout the day but can take a couple of hours analyzing the market every night. So you can see this is a very simple one, and it's good for people that are working that during the day they have no time to analyze market for them to place trade. You know quite well that forex trading is 24 hours uh, business activity. So even when you have closed from work during the time, you still have time to analyze market, and maybe you feel that pending order will be okay. You place your pending order, and then you allow the market to run. So you can allow the market to run 2 days, 3 days, depends on when the market actually hits your target or when you are okay with the profit or loss. So that is a swing trade. Swing trade is majorly for those who are working class that have no time during the day to watch market. So you are actually in the night, you check market. And before doing that, I've already said the step earlier. Things to consider first, you consider the current event, you consider the price of other assets, you consider the forex market development. You must put those things into consideration anytime you want to analyze market, be in the night, morning, or at lunchtime, any time of the day, night that you have time to do that. You know, some of us we are family men or women, so we maybe during the day we have a lot of time that we spend on other activities, and we feel that night is better for us to do analysis. So you must round everything up, then you come to conclusion on what to trade. Now, if you want to trade as a swing trader, what time frame do you actually use? So as a swing trader, you start your analysis, market analysis, from month to know the overall trend of the market. So now you switch to the weekly to know the trend. From weekly you switch to the daily, from daily to 4 hours, from 4 hours to 1 hour. So after you have done that, your entry point, which time frame are you using for your entry point? So your best entry point can be 1 hour, on 1 hour time frame that you use for your entry. So it all depends. When you now want to set your stop loss, so which time frame are you going to use for your stop loss? If you have used 1 hour to set your pending order to enter market, so you must be able to use daily for your stop loss, because the daily chart time frame will shows you some major support and resistance. And I've said earlier, the best way to trade is to look for those strong support and resistance. If you are a swing trader, support and resistance, those strong support and resistance, those are where you should target for your take profit and stop loss. So that is how you should trade as a swing trader. But as a day trader, you're able to use maybe 4 hours also. You can use 4 hours for your stop loss and your take profit. Use 30 minutes, 15 minutes for your entry. So these are the different time frame you should use based on your time type of trader. Now we just want to show this is swing high. You hear of swing high, swing low. So when you open your you actually see in your chart. So talk about Japanese candlestick. So we have some double bottoms, double top that we have discussed. We have some higher high. We talk about the higher high through zigzag, which we discussed yesterday. So if you want to do this now, you can see this one is a form of a zigzag pattern, starting from the beginning. It's a zigzag pattern. It make a swing low. A swing low, you can also call it a higher, a lower high, low, higher high, higher high, higher high. So this is a swing high. Either you call it swing high now, you call it a higher high. So this is also a zigzag pattern in an uptrend, uh, in an uptrend. So this is how you watch it. Uh, this time frame also key. So if you are using, maybe you are using 1 hour. So that is why I say 1 hour for entry. So this is a very good entry for you, which will last for like 3 days for the market. Depends on how patient you are before you exit your trade. So now if this is a 15 minutes, it means that it's good. So if this chart is showing on a 15-day trade, or if it's showing on the 1 hour, it means that it's good for a swing trade. So these are the different on how you use it. So the last one we talk about type of trader is position trading. Now this is a longest term trading and it can have several months. How many of us have this patient? Very of us, but those that have the patient do make a lot of money from it. This kind of trader is reserved for the extra patient traders and require a good understanding of fundamental. So now we are talking about this. So this can refer us back to the time the euro zone started their QE, which they call the quantitative easing, buying, printing of currency. So this is a very expensive policy that the eurozone put in place. And the moment they announce this, it bring that euro currency to the minimum because the exchange rate is zero. So now, for a very longer time, this has been something that the market has been using against the eurozone until recently, when the news started coming up now that the eurozone are gradually about to wind up the program, the QE program. Same thing applies to the Japanese economy. So those are the events that some people that want to trade on a longer time follows the fundamental analysis. So the news that come from the CBN. So some CBN, they talking about how to increase their interest rate. So these are the information that those who trade on a position in long-term trade take advantage of. So they place their trade and go to sleep. So allow the trade to run for several hours. So that is this. So a lot of people that trade this leave their trade for several hours because the position is held for so long. Fundamental thing will be predominant focus when analyzing. So you look at the future, what the future economy of that market, of that currency is like compared to the other currency. So as we know currency are be traded in pairs. Two currency must be involved. So that is this for this. So based on this, now there is time that it's be advisable for you. If you want to have a long-term trade, you should be able to have a long-term trade on euro or pair in a very soon time. That event will happen on euro that is going to last for close to 6 to 1 year. And if you are able to hold that trade, you make a lot of money because now eurozone and on the line of increase, uh, hike their rates. And once euro hike rate is definitely going to appreciate the euro currency as well. So you follow that news, the news on Europe on how they will start the current program. That is that for positioning trading. So now we talk about risk management. So risk management, is not every time that you open your chart, place a trade that you expect to win. Trading, there is nothing like 100%. Nobody can tell you that it's making 100% success all the time. You can make 100% for a day, but you can't tell me that throughout a week, throughout a month, all your trades will always be 100%. So what now happen when those trades go against you? Now, do you have something in place? Do you already have a program that's okay? When this market go against me, this is where I can stop the loss of my trade. This is where I will stop. But unfortunately, most traders have been falling victims of this simple concept. The simple concept is risk management. How are you managing your risk? How are you managing your trade when you are in a losing position? Do you already have in mind, set in mind, okay, this is where I will stop my trade when the market is going against me? But a lot of people actually fall victims. They allow just one single trade to run down their account because of poor risk management. So if you are of that type of person that allowed one single trade to run down your account, try and change, and you need to use proper risk management. It's very important. Risk management is one of the most important topic you will ever read about trading. Why is it important? Well, we are in the business of making money, as I've said, but not just always. And in order to make money, we have to learn how to manage risk. Potential losses are also there. For every trade you place, there is potential loss. For every single trade you place, there is a potential loss. So what are the potential loss? You would have find you have done your proper market analysis and the market is going well in your direction. all of a sudden the market may change direction based on a current event. Some breaking news can just change the direction of the market within in less than a minute. So that your analysis will become a negative. So at that moment, what loss side you said, okay, if this market is going against me, I should be able to take this loss and get out of the market and wait for another opportunity. So those are the things that you also put in place. If you are a scrapper, you must have a proper risk management. You know, as a scrapper, market move faster. As it's moving, you are buying, you are selling. As it's moving, you are buying, you are selling. So if you now buy, being a scrapper, you end up taking off your money, because as a scrapper, you may decide to use a higher loss size because you are scrapping. It means that you are not using a risk management. So don't be a scrapper. Don't be a scrapper and you are risking a higher loss size. So it may hurt your account. So you simply determine how much your customer will lose in a single trade and hit the trade button. Before you do that, you already have it in mind. Don't be greedy. Once you get to that point, exit your trade so that your account will be safe for other trade you want to place. So now we talk about leverage. You know, some of us, when a broker, you open a broker, you start asking yourself which leverage should I use, or you start asking people which leverage should I use. So leverage, we have actually discussed this before. For those who were not with us then, a leverage is having the ability to control a large amount of money using none or very little of your own money and borrowing the rest. Who are you borrowing the money from? You're actually borrowing the money from the broker, because the broker gave you the leverage. It means that that leverage allow you to trade with a higher volume of money. So now let's explain it this way. For example, to 100 position, your broker will set aside 1,000 if you are using 1:100. So how do you calculate this? This 1:100 or 100:1 simply means that for every 1 unit of currency that you want to trade, for every 1 unit, so this 100 allows you to trade 100 units by bringing just $1. So you want to trade 100 units of currency, you have to bring just $1. So that $1, the $99 remaining is from the broker. So we gave you the license to trade on $99 because you already dropped $1. So it means that when you have $2, you're able to trade in $200 currency. When you have $10, it means you're able to trade 1,000. When you now have 100, it means that you're able to trade in 10,000 unit currency. So you are able to control 100,000 with just 1,000. So now when you set 500, it means that one currency, $1 will allow you to trade on 500 units USD. So you see how huge that is. It means that you control $100 unit of USD with just $200. So for everything that have advantage, also about the advantage. So I will explain to you how the lot size, the leverage actually work when we are doing our calculation. Now here we are, we talk about margin. Margin is the amount needed by a good faith deposit to open a position with a broker. Now we already have a leverage. Now the leverage I already have is 500:1. So it means that with $200, you can actually trade 1,100 units of USD, which means on a standard account. So it means that one single trade, just place one single trade now, your margin will automatically enter zero because you are already buying the whole $100 units, $100,000 unit currency using the one lot size. So this is how it is expressed. Margin is usually expressed as a percentage of the full amount of the position. For example, most forex brokers say higher 2%, 1%, 5 0.5%, 0.25% margin. Now, this is the loss side, the leverage your broker or you choose from your broker. It means that your margin will be 1%. So for every trade you place, 1% will be taken from uh your trade. So now the other one is when you set 1:200, it means that 0.50. 1:400 means 0.20. So this is how it is when you are talking about the margin. And whenever you place a trade, the margin will remain. You see the free margin. So the high, if you are making profit, the free margin will be increasing. When you are losing, the free margin will be decreasing. Meanwhile, the margin will be reducing based on the number of trade you place. So the margin itself will be reducing based on the number of lot size you place. So take for example now, you open your chart. Now you not place any trade. Your free margin will be 100, your margin will be 100, and your deposit, your equity, and your balance, everything will be intact. So immediately you place a trade, maybe it's a ratio, your leverage is a ratio 1:500. Immediately you place zero and you have $200 in your account. Immediately you place 0.01. That 0.01 will automatically be removed from the percentage, which is a 0.25 will be removed from your margin. So when the trade is running on a profit, so it's the profit will now increase the level, the free margin. When it's decreasing, the loss will be decreasing your free margin. And once your free margin enter minus, so you receive a a margin call. So a margin call is just an emergency call that you receive, the broker telling you that you are already on a negative margin. And when you are unable to provide more money to hold your margin, so your trade will automatically close it. So it's just like this way. Just explain this way now. Now, broker require you to provide 0.02% to remain on a margin. So in the moment your account is going on negative, it simply means that you have no money to hold that position. So what's happened? The system will automatically close your trade. So that is all about margin and margin call. So we talk about the lot. So what do we talk mean about the lot? Lot is the unit of amount, is the unit amount of a particular currency you want to trade. So we talk about the standard lot. Standard lot, 100,000 unit make a standard lot. 100,000 unit USD make a standard lot. 10,000 USD units make a mini lot. Micro account is just 1,000 units. Now, how do you set your lot size? Lot size, your position size, or you call it your volume. How do you set it? Under standard account, when you set one lot size, it simply means that you trade your entry. You want to trade 100,000 units of a currency. So now when you set 0.10 under standard account, it means that you want to trade 10,000 units. Trading 0.01, it means that you want to trade 1,000 units of that currency. So under micro account, one simply means you are trading 1,000 units, but micro account, one lot size is just 1,000 units. So 0.10 is the least that you can trade under micro, which is 100. So there is no room for you to trade 0.01, which will give you just 10 units of currency. So the least is 100 units that you can trade under micro. So you can trade higher. When you set this one or two, it means that you are trading 2,000. When sent it on 3, it means that you are trading 3,000 units. The higher it goes, the higher the number it reflects. So now we talk about points and pips. Now, most currency are being quoted in 5 decimal points. So point is the measurement to express change in the value between two currencies. Take for example, we talk of Euro USD movement move from 1.17 thousand to 1.17,200. So what simply means now that the market has appreciated with 200 points, and this 200 points in pips will be 20 pips. So take note, 10 points makes 1 pip. It means that 200 points will be 20 pips. Now, how do you now calculate your profit and loss? Now, the pips divided by the price, which is 1.17,200 times 1 USD equals to the amount. So whatever the amount is, you times it by the lot size. So the lot size equals to the profit and loss. So it simply means that the lot size we are talking about here is that when you are under standard account, the lot size is 1,000. So it means that you make 20 pips. So 20 pips divided by the price equals to this. So times 1,000 units. So you are using the unit that you actually bought to calculate it. So 0.01 in a standard, it means that when you are on a standard, 0.01 is 1,000 units. So you use the 1,000 unit times this particular value, it give you 1.71. So this 1.71 is euro in euro. So this 1.71 now times the rate at that moment of Europe to USD, you times it, will now give you the main profits, which is $2 for 20 pips when you are using 0.01. So all you just simply means that 10 pips 10 pips now will give you $1, which is just 100 points. So 20 pips will give you $2. Now, if you are now decide to use the higher the lot size, the higher your profit and loss. Now, if you choose to use maybe 0.10 as your loss size, so you times the 0.10 times this, it means that you are going to make $20 per 20 pips. So it means that 20 pips will give you $20. So if you are using 0.02, it means that the dollar from the 20 pips, if you use 0.04, it means that what we get will be $8. If you use 0.05, what we get will be $10. So the higher the loss size, the higher your profit or loss. So because now this 0.05 will give you 5,000 units. 5,000 units times this will give you this price. This divided times the price, the current price exchange euro to USD is price. So this is how you calculate uh, your profit and loss based on the pips and the current price. So I always said for further explanation, you can reach me on via WhatsApp for more further explanation on how you calculate your pips. So though sometimes there are some application that give you a calculation to calculate this without you, but it's also good for you to know it manually. So that is for pips and points. So I think that is where we end our class today. So the next one I'll be able to discuss now is about uh, let me see if I can cover the the price action. The price action it does talking about market, it's market analysis of the market, of the price movement of the market over a period of time, per time. So what we are simply saying here is that Forex price action is the analysis of price movement of the market over a period of time. So you don't have to use don't need to use indicators for if you are a price action trader. All you need to understand is the Japanese candlesticks. So because I said yesterday that every candles have interpretation. So if you are able to read those interpretation of those candlesticks, you're able to know how to use a price action very well. So price action, you don't need to use an indicator. You don't need any indicator. So the only thing that you can use to support you when you are using price action is for you to plot your support and resistance zone. So how do you do that? We have said the best way to plot your support and resistance zone is using your line chart. So when you use your line chart, just take your chart, your time frame to maybe monthly or weekly. So now plot those line on those major support and resistance using the line chart. So now, so those one will now be a guide when you are using your price action, because in price action you don't need to use a indicator. So after plotting your support and resistance through the peaks and the valley, so now you can bring your time frame back to 15 minutes, 20 minutes. So whenever these uh candles are approaching those lines, you already know what you are expecting to happen. Either you expect a breakout or a bounce back or an uptrend or a downtrend. So that is how you analyze a price action. So price and direction bias, as well as identifying current the current pattern that will depict change or continuation of a particular sentiment. So through price action without any indicator, you're able to know when market is about to change, or if that market will continue the same sentiment during a period of time. So that is it. So it's just a raw chart that you face, and you're able to interpret those Japanese candlestick and make your decision on when you feel that the market will go. So most uh, candles that you can easily use when you are trading on price action, you can work on a pin bar. So because most time the pin bar will surface after an extended downtrend on an uptrend. So most time you check your weekly chart, daily chart. So some of the pin bars are very reliable when you are using the price action. Very reliable, those pin bars. So those pin bar, the uh, support and resistance line that you plot will give you the inside of where those major support and resistance are when this pin bar actually uh, have come up. So you use it to trade have your trading opportunity. I think this is where we end up our training today. As I've said, I still need to organize a training in some other time to talk more on price action, or how you use a moving average. Was sometimes moving average are also very good for you to enter a trade. It can also act as your support and resistance also. Moving average acts as support and resistance also, and sometimes to make a trade. There are some moving average that when they cross, they are reliable for you to enter a trade. if you cross down the smaller period, cross over the higher period, or when a price market touches the 200 moving average, there is always a reaction. So in the next class we're able to cover all this. Thank you for today. We give glory to God. So this is tips and points. So the best way to calculate it, if you want to use your calculator before you enter a trade. As I've said, you use the unit currency, not the lot size himself. 0.01 lot size is 1,000 units. So when you are doing your calculator, you use the units. You should be able to know every lot size, what it is in terms of the USD units. So we talk about the lot size. So lot size is for standard account 100,000. So it means when you have $200 in your account, you should be able to know what lot size you should use for a proper risk management. So this is the lot size, your margin con, where your free margins are theta minus zero. So already you are already in a losing position. Types of lot size, what every leverage implies. We 500 to 1 ratio means that for every 1 unit currency, you are able to trade in 500 unit currency. So it means that when you have $100 in your account, under standard account, you have 500 ratio 1. It means that you are able to trade 50,000 units of USD currency with just $100. So the there is advantage and disadvantage, because when the market is going in your favor, your profits will be calculated based on that 500,000, 550,000, pardon me. So when you are losing, it's also going to be calculated based on the 50,000 units. So that is that for leverage. So we talk about risk management. I always know what you can lose. We talk about position trading. So a long time trade. Talk about swing traders. So this how the chart swing up, swing up, swing down, moving a zigzag pattern. So this is a swing trade. So we talk about the swing trade, the long trade style that require patience to go a trade. So it's not a position trade, but it can take days, 2, 3 days. While position trading takes months. Swing trade is just days trade. So we talk about day trade. So day trade within a day, when it close to the second day, you have already turned your trade to be a swing trade. So those are what decide before you choose to be a scrabber. Scrabber. So scrabber just holding a trade for few minutes, few seconds. You exit your trade and now look for the next trade. So we are unable to com- complete dollar index today. Also, and dollar index is just all about the strength of dollar to green pocket. That's what we call it to other market currency. So we talk things to consider before in your market analysis. Things to consider in your market analysis. Things, so these are what we have covered today. As I've said, we still schedule a time to cover those areas we have not able to cover in this part of the training. So, so these are if you want to write a note so that you're able to summarize one or two things. Then we close the trade. Thank you all.